Okay, so now let's get into investing. And let's talk about investing in the stock market in particular. Now, investing in the market is a topic for which no one can explain in 5 minutes. It's something you can spend a lifetime studying and still not fully understand. That's what happens when the market is moved around by the decisions of millions of other investors. It's just a very complicated topic. But let me tell you what I think is the single most important part of successful investing. There's a scene in the movie Lawrence of Arabia when Lawrence puts out a match with his fingers and doesn't flinch. He just takes a match and puts it out and he's fine, doesn't even flinch. Another man watching it tries to do the same and he yells in pain. He says, "Ow, it hurts." "What's the trick?" he asked Lawrence. Lawrence looks at him and he says, "What's the trick?" The trick is not minding that it hurts. The trick is not minding that it hurts. It's such an important lesson in so many things in life where there are no hacks to get around the pain. You just have to learn how to deal with and put up with and endure the pain. Such an important lesson, including in investing. Maybe even especially investing. Let me show you 2 pictures that I think really sum this up. This is the S&P 500, the US stock market, going back to the 1950s. And it's great. You made a ton of money just by holding on and letting your money grow. You didn't really have to do anything. This is like the picture of success. This is as good as it gets over a lifetime for an investor. But everything good in life has a cost. If you want something great, you have to pay the price. That's true if you're buying a new car or a new house. You want a nice car, it costs a lot of money. Everyone knows that. There's a price. And investing is no different. Yes, you can make a lot of money in the stock market over a long period of time. That's true not just in the United States, but in a lot of markets all over the world. The long-term history of investing is pretty promising and pretty astounding. But those returns don't come for free. No one is just handing you those returns because they want to be nice to you. You're not entitled to them. There is a cost to earning those returns. There's a price to pay if you want good returns. And that price isn't paid with cash. It's not paid with money. You pay for it by being forced to put up with volatility and uncertainty. Here's another way to view the same chart that I just showed you. This shows the drawdowns, the times you lost money in the stock market when the market was down from its previous all-time high. And it's a mess. You're losing money all the time. Now here's what's important. At every drawdown in this second chart here, there were investors all over the world, millions of investors who would open their brokerage account and they would say, "This is wrong. This doesn't feel right. Something feels broken. It's uncomfortable and it hurts. And I don't want to be hurt, so I want out." And they sell at just the wrong times rather than holding on and letting their money grow over time. Most investors expect volatility. They get that. But what's easy to overlook is the amount of volatility that can take place within the context of otherwise very good returns. And how the trick then is learning to not mind that it hurts. The market in the United States has historically spent more than 6 times as many days down more than 10% from its previous all-time high than it has at a new all-time high. Now, every investor is different, so how much risk you can handle and how big of drawdowns you can stomach, it's different from person to person. I'm not trying to say that everyone should be willing to put up with a 50% decline. Risk tolerance is different depending on how old you are, where you live, how much money you make, etc. Those kind of things. This was why things like cash and bond allocations are so important to blunt the market declines in the stock market. But it's just so important to understand that there is a cost to investing, a price of admission, so to speak. And that cost is putting up with and dealing with uncertainty and volatility and not minding that it hurts. Now here's something really important. There are 2 ways to view market volatility. One, like I've said before, is to view it like a fee, the cost of admission, the price that's worth paying to get something good in return. But most investors, I'll tell you, don't view it like that. They don't view volatility as a fee. They view it as a fine. A fine like they did something wrong. A fine means you're in trouble. Shame on you. Don't do it ever again. That's what a fine is. And when you view stock market volatility as a fine, you tend to think, how can I avoid it? How can I make sure there's no volatility in my portfolio? Which causes all kinds of bad investing behavior. It causes people to sell and trade and panic. It means that sometimes they don't trust the stock market, all because they view volatility as an indication that they did something wrong, rather than viewing it as a fee that you have to pay to get something great in return. You know, I think a great way for most people to invest is just put your money in a broad, low-cost index fund. When you do that, you're effectively betting on humanity. Not any one individual company, but you're betting on humans' ability to solve problems and grow and become innovative. It's also a great way to protect your money from inflation over time. Owning a big, diverse portfolio of good companies that can raise their prices is one of the best ways to ensure that your assets grow at least with inflation over time, so you don't lose purchasing power and watch your wealth erode. That's maybe the first step in investing. Diversification, low cost. It's an important step. But the most important step is that what you own, whatever you own, you view volatility as a fee and not a fine. That you realize that your portfolio losing money on occasion doesn't necessarily mean that you did something wrong or that you made a mistake. Almost all the time, it just means that you're paying the price of admission. And the number one key to becoming a good investor is not minding that it hurts.